All right, so we've got like a serious situation here this morning, Mark, but the S&Ps and every index, especially the NASDAQ, it's such a big run coming into this. So help us figure out from a technical perspective, how big of a sell-off should we be worried about? What should be perceived as just a much needed type of pullback, correction? At what point does it look ugly to you?
Yeah, that's right, Oliver. Good morning. So it's important to note that we've really seen very little overall weakness in prices itself. It was more just things like credit, China, the dollar-yen breakdown, crude oil. So there were a lot of things that happened actually ahead of U.S. markets peaking out. And so initially, when you see a sell-off from a situation where we've seen very, very little weakness, normally that's right to try to buy the dip on this first decline when you see some evidence of exhaustion on the downside. So I don't know that we'll see the real signs of capitulation just yet, but my thinking is we see 3 to 5% down initially, and that marks at least a trading low, and then we'll see what happens on the retest. But we're certainly overdue for this pullback based on quite a few metrics. Sentiment had gotten very optimistic. We'd seen the 13-week ratio of the moving average of the put to call get down to levels we hadn't seen since 2011. So we were seeing really 2 calls being bought for every put, and that's normally a time to really pay attention. You couple that with the fact that momentum had gotten very overbought on a weekly basis, but really on a daily, we'd started to see real negative divergence. Prices had rallied almost 10% over the last 3 months, but yet things like RSI had not even reached levels that were seen back in December, and it certainly flattened out on a monthly basis. So momentum was showing us reason for concern. Sentiment was showing us reason for concern. We needed to see the catalyst. My thinking that was China, what happened with dollar yen, treasury yields, and crude. They all sort of broke and rolled over at the same time. That was really something to pay attention to, along with the fact that defensives had really started to pick up again. That's always a sign for investors to pay attention to. When you see utilities outperform technology, really over the last month, we're very neck and neck with regards to how utilities have done. That's certainly a little bit of a wake-up call for investors that have simply been watching indices hit new high after new high, day after day. We know that indices obviously are very concentrated now. The top 5 stocks account for about 17% of the S&P, so that's normally also something to not get too complacent when that's happening.
Mark, so now that we've got this move down finally after a market that went through just about every potentially negative headline and bought the dip and moved through, now that we had a ton of opportunities to have the selling, but the market's found its thing here. So when you look at a longer term S&Ps, what's the perspective we need to keep? Because when you've been in that type of charge forward, you get pretty far off moving averages. You get pretty far elevated the upside off trend lines, obviously depending where you draw them, but it seems like there's plenty of room before there's real breakage of trend, right? I mean, don't we have like 5-10% before we even get close to like an important moving average?
Well, when you look at the broader indices, most of them are challenging those trend lines this morning. So the S&P, that lies right near 3250. That's really the trend from last October's lows. The NASDAQ and the Dow really have similar type trends that undercut really right where futures are showing prices can open this morning. So we are at levels that are somewhat important in the short run. I would argue that this has really caught a lot of people off guard very quickly, and it could continue into the early part of February. So I do think these uptrends are going to be broken. But moving averages to me are not something that ordinarily are all that useful with regards to support oftentimes. When people talk about the 50 or the 200, but many times it's the trend lines you want to pay attention to and or look at Fibonacci retracements in price and time. So I look at things like 3153 for the S&P, which is a 38.2% Fibonacci level, or 3096 is 50% of what we've seen since last October. So those are going to be pretty key as to what could hold. But my level really is 3210. Initially, that's a GAN level, and it's also right near January monthly lows. So that'll be the first level that comes onto my radar if 3250 is broken. But I've been writing about this for the last couple of weeks. There's been a lot of warning signs, and now we're finally seeing price confirm what all these other things have been suggesting could happen for the last couple of weeks. So for me, this has very little to do with the coronavirus itself, and a lot of just about what the warning signs and some of the cycles have been suggesting could be possible in the month of January. So, it's a true shot across the bow from how I see it.
So, Mark, and I think that's an important note here, which is, especially coming from a technical perspective, it's hold the narrative. Let's, watch kind of the signs that are now lining up. And by that, definition, a lot of things you're describing here, stocks coming off, is more fitting into a puzzle, a piece that kind of fit into a puzzle that was making more sense even before this. I want to go to bonds, though, because for the stock market, it seems like we've got enough, froth that had built up to really kind of any downside would be a piece that fits in the puzzle, right? It's just so much so fast. For bonds, to me, it's an interesting one because this was one of the, I think, the most important charts, if not the most important chart, which was kind of which way the 10-year yield was going to break in that wedge or triangle. Everybody had their own drawing, but everybody knew that an event had to happen. Bonds are breaking that to yield downside, clearly related to this news here. So for bonds, it seemed like it was a little bit more of a coin flip, right? Which was, which way is this thing going to break here? There's cases on the narrative for up, there's cases for down. So how important is it that technically we broke lower on yield?
Well, from an Elliott perspective, you could study this whole consolidation over the last 4 months and say that it was very corrective in nature and that this really needed to break to the downside. I mean, bond yields and stocks had been acting pretty much in tandem for the last couple of years. Up until recently, we saw, yields largely stall out over the last few months, whereas stocks moved higher. And then, of course, from December, yields peaked out right around, 195 and started to drop precipitously. And so, the break of that little triangle that you mentioned, is certainly very important to the downside and a positive for treasuries, negative for yields, thinking that yields, should start to move lower. So we're at 163. We moved down about 30 basis points in the last month now. I think that, near term, we've moved a lot very quickly. 163 could, I didn't see what we are in the last 15 minutes, but in general, we are close to levels that should hold temporarily, but I think we're going to test 142, which were the lows from last September's lows, and potentially get under that before it's all said and done.
So you're looking for more.
I view that as being.
You're looking for more bond buying, lower yields now that we've broken this.
Over the next 4 to 6 weeks, I would, not necessarily the next 2 or 3 days, but yes, that's correct. I think the yield curve has started to flatten out again. That's also important. We'd seen one of the best performing sectors last year, financials. Of course, those are over, really just heavily weighted into a few stocks that were making the move. On an equal weighted basis, financials was still not really showing the kind of movement that you would have seen by looking at XLF. But, the fact that the yield curve broke down, financials started out the year in more of a mean reversion type mode and weakening. That's always important. This group is, I think, the third largest of the S&P. So when financials turn down, banks have been weak, even throughout this great earnings season. It makes you really scratch your head as to something else is going on. And of course, those have largely followed what's happened with Treasury yields over the last few weeks. So that's important.
Mark, just real quick, because we got to take the bells here in a sec, but how brutal is the chart for crude oil? I mean, it just keeps getting slammed. It's now, what if it breaks the bottom of the range it's been in for the last 9 months?
I think it's tough to anticipate that right away. I think the level near 50 is going to be very important. I think it's down about another 3% this morning to 52 or so, but we're very, very close to levels where crude should at least stabilize. One would want to cover shorts down near those lows, at least initially, but really you want to play on any bounce. I think that the severity of this break happening very quickly like it did is normally a concern when it happens that quickly. Momentum is shifting very strongly to the downside all of a sudden. So it could be, the lack of demand when you see the virus spreading. I'll leave that to the experts. Technically, it is bearish near term. You want to really find support near prior lows, and that's really the first area you want to take a stab.